I think we're going to see the same arc of evolution in crypto, which is every business is going to be using crypto, whether they realize it or not. It's just, you're just going to, it's a step function improvement. And most of that involves stablecoins, which I know you guys like to talk about that. Like, core to our thesis is acquiring businesses and making them more efficient and introducing a new product line and monetizing that user base with stablecoins. There's other things to it, but that's like, I hope that, I guess, success for Inversion is to onboard 1 billion users and take traditional businesses and making them more efficient with crypto rails.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of real-world assets. I'm Simon Taylor, your host, author at Fintech Brain Food, and head of strategy at Sardine. Joining me is Cuy Sheffield, my friend and head of crypto at Visa. How you doing, Cuy?
I am fantastic. What a week. We have a lot to unpack.
Oh my goodness, do we? But also joining us today is Santiago Santos, the CEO of Inversion Capital. How you doing, Santi?
I'm doing great. Thanks for having me on, guys.
Thank you so much. Well, look, let's get to Inversion Capital in just a second, but I just need to remind viewers and listeners, views and opinions of our contributors today are their own and might not reflect those of the companies they represent. So please don't take anything we say as tax, financial, legal, investment, or any other form of advice. It's not even astrology. So before we get into all of the news, and my goodness, there's a lot this week. Santi, tell me a little bit about Inversion Capital. I love that you're coining it Berkshire on chain. Of course, the GOAT has now retired. So tell me the thesis.
Well, yeah, I guess now that he's retired, someone needs to take his place, especially in crypto. I'll tell you, look, I've spent over a decade in crypto, and it's always been a nagging question of like, you guys really understand fintech, and you come from that world, and I think you see the opportunity of like stablecoins and whether you believe they're room temperature semiconductors, as the Collison brothers calls them. But genuinely, I mean, Cuy, I remember you were one of the first people at Visa. It's like Visa as an organization really excited about stablecoins. And so where I come at it is like, I've been just frustrated that we don't have more users on chain using these core products. And I fundamentally believe, after investing in over 200 companies in the space, the tech and the timing is very much right. So Inversion really is taking a private equity approach, meaning I'm of the mind that you can buy a traditional business, and we can go into which ones, and transform them with crypto elements. It doesn't mean that the entire business is crypto native. It just means transforming an existing asset with certain very specific things that make it more efficient, that you can cut costs, time, costs, or introduce a new product line. And in a similar way that like businesses 20 years ago were still making the distinction between like an internet and a non-internet business, now every business uses the internet. I think we're going to see the same arc of evolution in crypto, which is every business is going to be using crypto, whether they realize it or not. It's just, you're just going to, it's a step function improvement. And most of that involves stablecoins, which I know you guys like to talk about that. Like, core to our thesis is acquiring businesses and making them more efficient and introducing a new product line and monetizing that user base with stablecoins. There's other things to it, but that's like, I hope that, I guess, success for Inversion is to onboard 1 billion users and take traditional businesses and making them more efficient with crypto rails.
Very cool. I love the thesis. I think there's a huge opportunity there. And it's also just really interesting to see how traditional organizations are trying to navigate stablecoins. And many of them who haven't spent time recently, there's a big learning curve. And so, how to get up to speed, how to learn how they work, how to apply them to the business. I could definitely see how many of those companies need help, and there are different models. Some of them are going to consultants, some of them are doing investments, joint ventures, and so having a private equity approach, bringing expertise with stablecoins, coming in, I think is a really cool thesis.
Yeah, I was listening to a podcast about the evolution of Visa as a network, and most people like take for granted how credit cards are so prevalent now. But my God, like 20, 40 years ago, 30 years ago, like you don't have to go too far back in history to appreciate like these things were like incredibly painful and took a Herculean effort to get off the ground. And it's so interesting because I felt like Visa as an organization has really taken like for many years, just like really appreciated the opportunity of what crypto can really mean for your company, right? So I think we're in a very interesting time in the market where like crypto natives are skeptical or tired because prices are not doing anything. But it's organizations like Stripe, Visa, and others that BlackRock that really appreciate the opportunity at hand, which is you can really cut costs in a very meaningful way.
It's interesting watching the kind of discourse on X and Farcaster and others, and there is this like sort of crypto native sort of nihilism that's almost crept in as real world adoption is finally coming and the institutions have arrived. We had Mike Hudak from Sling Money on the show several episodes ago, and because he was chief product officer at Monzo, he worked at Meta for many years, and what he described is, imagine if somebody took 80% of the infrastructure you had to build for a financial services company and just outsourced all of that cost to a network, then you would be in a completely different place. I'm interested in how you think about that transformation. You have this phrase that I saw in Frontera that was onboard through acquisition, scale through necessity, retain through utility, and repeat. Like, how does that play into what you're thinking about?
Like, I guess if you were to like describe what Inversion does and try to prompt it with like ChatGPT, it would be like, which platform business can I buy at the best price possible? Because price really dictates everything here. In a perfect world, I'll go buy JP Morgan and like, run this transformation. I don't have $1 trillion yet. But I think like what's interesting about what we do is, again, a telco company, especially an asset-light telco is primed to do to be that Trojan horse to onboard users, right? Because every user right now in crypto goes through an exchange. That's just fundamentally broken. Like, we're not going to sell people life-saving products and normal products, because when you go to create an account or an exchange, you're thinking about buying Trump coin or Peanut or Doge, and I think the retention's not there. Like, you guys are normal. Like, when you look at it, unit economics are everything about a business. We have terrible unit economics in crypto, not because we haven't built great products, but because the retention's not there, because everyone just comes in thinking they're going to speculate. And so again, you need to invert that script and say, how can we activate a user without the speculative energy? It's really transformational technology. Crypto, getting people to use a credit card 20, 30 years ago was painful. It took a while. But I guess the flow looks something like this. You buy a telco company. You live with a customer 24/7. You buy this for like 5 times EBITDA, by the way, in a place like Latin America. And then you re-architect that wallet so that, that wallet becomes not just the telco app, it becomes a bank, meaning people see the ability to pay for services at the for mobile services, but also hold dollars in a bank account. I don't know if you guys have been in Latin America, but most people cannot hold dollars in a bank account, but they very much want to. And so this is where the activation energy is very powerful, which is you're offering, like, Nubank, as an example, probably one of the most successful fintech companies in the world, 100 million users. They got to scale where pretty much no other fintech in the region has been able to do. They were extending $1 credit lines in a bright purple card to users. David and the team just really understood the user exceptionally well, but we can do so much more. And by the way, Nubank is already doing this in many ways. They had a crypto strategy, they had a crypto wallet, they even have a Nubank token that kind of went nowhere. But now that they've enabled USDC on their wallet, it's the number one asset that users buy. And that's telling you everything about where we're going. Like, people want to have dollars in a bank account, and this is how you do it, right? This is how we get 100, 200, 300 million users, right? And so simplistically, that's really it. I mean, a lot of people ask us, why telco? If you think about it, telco is really interesting because you have so much data on these users to extend credit. M-Pesa has done it exceptionally well in Africa. You also live with a customer 24/7, and you have every user that has a SIM has already been KYC'd. So in order to be compliant, there's just a lot of reasons why we like this asset to be. This is not a mobile telco play. It's a fintech play with a really interesting customer acquisition strategy, which is buying an asset that is very unproductive. So that's really the core thesis we have. Like, most telcos in developing countries will become banks, and you do that when money's truly digital with stablecoins.
And in a lot of these markets, telco adoption is not the issue. Everybody has a mobile phone. So you have the distribution already. What you don't necessarily have is the business model, but you've also proven the demand for that business model is there. You're connecting the two to the mainstream, which I think is very sensible. You've also been building your own L1 network on Avalanche. So that doesn't strike me as a classic private equity play from an infrastructure standpoint. You're definitely not living in just pure PDFs here. Is this changing how, what's the purpose of that? What's it doing?
Well, it really acts twofold. One, a vertical integration approach is necessary to finance acquisitions, right? Because you go and buy these businesses. Why would I leak that value to another chain? All the settlement, MEV, transaction, on and off ramps, like it makes no sense, right? Because we want to accrue that value at the chain level. I think most people are you hear a lot in the timeline, a lot of these differentiations with high throughput chains. My view after investing in most of them is there's very limited differentiation. The real key is the go-to-market. And Avalanche just provides that architecture out of the box to allow us to be high performant, high throughput, EVM compatible, low fees, right, which are necessary for us if we want to get to scale. But the real excitement here is I don't want this to be a private equity fund because I never want to sell these businesses. If you're a private equity fund, after 5 years, investors expect their money back. And again, what I want to do is I want to build the largest onboarding funnel for users to the crypto economy. And the way to do that is to have a permanent capital vehicle. So again, this is Berkshire Hathaway is such a great organization because they have permanent capital. Every major private equity fund went public to have permanent capital. They can access capital markets. They can sell their stock or use a KKR stock or Blackstone stock or Apollo. Apollo bought a life insurance company to get float. You know what I mean? So like having this permanent, more durable capital base as an L1, and imagine a world where we launch the inversion chain. We have a treasury to be able to strategically use to fund acquisitions. I mean, the question is, if you're Solana, Ethereum, any other L1, L2 that has billions of dollars in their treasury, why are you not doing this today?
Yeah, I think that's an interesting trend that I think we'll see more of. What is the future of a blockchain foundation? What does their mandate become, particularly as the blockchain scales? Do they start using those treasuries, to fund, M&A, and instead of just, giving out grants or doing investments, actually, buying and building businesses? And it's a really interesting, opportunity and thesis that touches on a lot of the points that we've talked about in the show, and then a number of news items, this week that I know we want to unpack as well.
Yeah. Yeah, last thing I'll say is like Ripple's already starting to do this, right? You're starting to see more M&A, but in the same way that like I guess foundations should realize that they have a very valuable currency that is very inflated, and so what did AOL do at the peak of the .com bubble? They went and bought a business 7 times their size called Time Warner that was very real, and I think that's sort of the position where a lot of these foundations are. It's not to say that they can't grow into that valuation, but they should definitely be more strategic about how they use that balance sheet.
Well, I think Tether is buying agriculture assets, and it's looking to buy into sports clubs and other yielding assets. So, the treasury management of some of these changes is certainly starting to change. Well, Santi, you are absolutely the right person to have us kind of guiding through the news today. And I'm going to segue here from the on-chain Berkshire Hathaway to on-show ad reads. So, just going to take a quick break whilst we hear from the folks that make this show possible. This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's Tokenized Asset Platform, or VTAP, uses smart contracts and cryptography to help banks bring fiat currencies on-chain, whether it's launching a stablecoin or deposit tokens or something else. VTAP allows financial institutions to issue fiat-backed tokens, improving financial efficiency and enabling programmable finance. Check out the links in this episode's description to express your interest in VTAP. Tokenized is also brought to you by Avalanche. Major banks, fintech challengers, and industry leaders are using Avalanche to create new business models on a fully customizable blockchain infrastructure. Think of it as more than a blockchain. Think of it as an entire network built for financial institutions to innovate. With purpose-built layer ones, institutions can tailor digital asset strategies to their exact needs while still tapping into the power of a public blockchain, innovation, developer communities, and seamless interoperability. Join the institutions shaping the future of finance on Avalanche, and you can learn more at avax.network. All right, thank you, sponsors. Thank you for making this possible. And speaking of sponsors, well, we've got the story that was kind of everywhere, which is Visa making a strategic investment in BVNK. This is like a match made in heaven. I'm assuming you guys didn't find each other through Tokenized, but I would love that idea. So this follows the $50 million Series B fundraise that BVNK did in December of last year. And Cuy, I guess you're the best person to talk us through this one.
Yeah, we've gotten to know the BVNK team really well over the last year, and are really excited about what they're building. I think we've talked about many times how much potential we see for stablecoins to play a role in cross-border money movement, but there's just a real need for infrastructure to make that happen. And I think there's both the need for orchestration and connectivity into local fiat banking. The ability to do on and off ramps, as well as the underlying technology to enable companies to make connections between their own liquidity providers. And so we look at BVNK as one of the leaders in the space, and we're excited to continue to figure out how we can work with infrastructure providers to help Visa facilitate cross-border money movement. And I think for Visa Ventures, we're spending a lot of time looking at crypto companies, different layers of the stack, and definitely plan to make more investments in the space soon.
Here, Santi, what are your thoughts when you saw this news?
I mean, I said it earlier. I mean, I've followed Cuy and what Visa's been doing for a long time. I think Visa's one of those like very forward-looking organizations that sort of realizes the possibility to transform their business in a very meaningful way, and I think this is just a way to express that view. So it's super, super exciting. I mean, I have a lot of questions, but I know you do too. But it's great to see.
The other thing that stood out about this is BVNK saying they process $12 billion annually for companies like Ferrari and Rapid, and that runs to about $1 billion per month in total process volume. Now, that's not quite Stripe's 1.4 trillion on an annualized basis. It's a ways to go, but I keep hearing how fast this stuff's growing, and we'll come on to it a little bit in the next story. But at Stripe Sessions, John Collison was talking about it's absolutely growing way faster than Stripe itself did in its early days. So there's definitely a momentum thing there. And actually, whilst I'm there, we might as well bridge to this story, which is Stripe launching stablecoin accounts. So customers of these new financial accounts will have 24/7 access to instant dollar-based liquidity in 101 countries. Although 2 of those are in the G20. It is backwardly compatible with ACH Wire and SEPA for Stripe customers who have access to those rails. And then, of course, John Collison showed just how fast stablecoin adoption is kind of growing. Santi, did you see this story yet? It's all kind of breaking as we record this on the Thursday, but any thoughts on this announcement as well?
I mean, it's amazing. Like that graph, he said, there's a couple of things in that presentation. It starts minute 24. Everyone should go watch it. He talks about like Stripe's growth, and he overlays that with the growth that they've seen with stablecoins, like with their Bridge acquisition. And it's like, as soon as he overlays the growth of stablecoins, it's like Stripe's growth is like muted. It doesn't even show in the chart, which is super impressive. He uses a term that I really like, which is borderless finance, which is something that is it's just a very powerful term. He has just a knack of like crystallizing terms in a very good way. But look, it's amazing. Like, go through the flow. I mean, he goes through kind of a demo of what it would look like to seamlessly kind of transition from stablecoins to bank accounts. And it's like, you need a company like Visa and Stripe to really change consumer behavior in a way that is like, it's kind of like inserts itself into that flow, right? Because everything in crypto today has been like, I'm going to pull you away from your day-to-day workflow and try to convince you to do things that you've never done before in a classical transformational technology sense. And it's just like really hard for the brain to process that. And very few people actually want to jump through barbed wires to like explore this technology. Doing it in this way is like a Trojan horse strategy, which is like, Visa and Stripe have massive distribution, but doing it in a way that the workflow is super intuitive, that the user thinks about stablecoins as money. And I would challenge, like, if you were to run a survey, most people would not think of a stablecoin as money in an exchange or in a crypto exchange or like through a wallet like Phantom or MetaMask. It's just weird, right? But when you see it when you're checking out, when you see it when you're logged in all of your workflows, I mean, God, this might be one of the more exciting time or the most exciting time in crypto, because this is how you kind of just sort of like embedded yourself in the workflow of millions and millions of people, financial institutions, businesses. And it's like, it's so powerful. I mean, I said it on record on Empire that like Stripe's acquisition of Bridge probably goes down as the equivalent of Facebook acquiring Instagram, because Instagram became so important to Facebook and they bought it for $1 billion. I think that's the scale. I mean, that's and the distribution is key here.
Yeah. Yeah. So to me, when I look at this, it seems like it really represents what I think about almost as like the third era for stablecoins, and there will likely be more. But like as I think about the eras, like my mental model is, the first era was that stablecoins enabled crypto companies to start to look more like global fintechs. And as much as I agree, Santi, the experiences haven't been great. You still had consumers finding that, hey, their crypto wallet let them hold dollars and send dollars across the world, and so crypto companies were not entirely speculative trading. They had some customers who used them for things that looked like fintech. So that was the first era. Then you had the second era, which was the enablement of brand new fintechs built from the ground up on top of stablecoins. And so Sling Money is a great example of nothing to do with crypto assets, just saying, here's this new infrastructure. Let me build something that looks and feels like a global Venmo on top of stablecoins. And then that gets us to the third area, which I think is what we've seen this week. Some of the largest, most successful fintechs who have been focused in a smaller number of markets, more developed markets, are now using stablecoins to go global. And I think we'll see this more and more, both in the fact that a lot of companies follow what Stripe does, as well as we're now at the point where as we get closer to regulatory clarity, as the infrastructure improves, as the user experiences improve, you can have companies who've been incredibly successful in one or a handful of markets say, now is the time to go global. And they wouldn't have gone global if they would have had to do local bank partnerships, have to figure out how to navigate a lot of the challenges of entering in a new market. Where now, if they could build a product one time on top of stablecoins and then offer that product to consumers or businesses in many countries, they're finding that there's that opportunity, and you can feasibly go global in ways that you haven't before. And I think there are going to be a lot of implications, and we're kind of just now starting to see the beginning of that era.
I love the phrase that Andrew Strange used once, which is like the potential to be default global, because you just can't be that. There is no real, truly global payments business. Visa and MasterCard are the closest things to it, but even there are lots of markets in Europe where, it's Ideal and it's Vips and it's Swish and it's UPI and it's all of these local infrastructure networks that were connecting peer to peer. The stablecoin sandwich just makes that, like, it abstracts it all. It turns it into the internet. You've got this middle layer now that is open, available, and instant. I saw around this news, Ramp, the spend management platform, very popular with startups, has announced that they're launching stablecoin linked cards in all of the markets where Stripe is making this available. So now suddenly you have this company that was very, very dominant in the US and issued cards in some of the markets for some of its employees, but it was a very US-centric company, has now suddenly opened up to so many more markets. I think that's sort of the implication number one here is don't just think about what this means for Stripe customers. Think about the product Stripe customers will offer out to the market and how big that's going to be. And then implication number two, I spent a lot of years in global cash management. Global cash management, if you're at a Citibank or an HSBC, is a network of building correspondent banking relationships. Citibank's in 90 countries, HSBC's in 60 countries. That's a lot of countries, but it's not 101. And yes, this is a little bit apples to oranges, but to my mind, this is the first real genuine threat that business line has ever faced. And that is like the comfortable, profitable, gooey bit of the bank where they had a moat around accounts and they had a moat around payments, and those moats potentially don't look the same. So it doesn't surprise me to see the bank lobby has started making a lot more noise about the Genius Act in recent days, because I think there is a slow waking realization, but there's also an awful lot of complacency. And I don't think as a bank you can afford to be complacent on this topic anymore. I think you really have to start to lean in. Santi, your reflections on, the potential for a alternative to Swift, is that just hyperbole, or is that really real?
I mean, I think it's very much real. We did a lot of research when we go talk to people that, over the years just don't understand crypto, but understand finance really well. And the amount of friction that you're removing from the equation is massive. I almost describe it as like, I think the Collison brothers, like buying Bridge is the strongest signal you can have, because like if they're at the forefront of fintech, they sort of realize that there's a natural limitation and ceiling to how much you can innovate around the current constraints of the financial system that, by the way, predates the internet. These are all databases that kind of stitch together in a very clunky way, and that naturally has a ton of friction. But like, I mean, you mentioned global trade. That's something that the Collison brothers yesterday, like, always reference that as an example. Like, if you're a company of scale, or like SpaceX, Tesla, you have international vendors. You need to pay them in real time. Stablecoins allow you to pay them in real time. Like, that's incredibly powerful. And so naturally, like, I don't think it's an understatement that. I mean, maybe a better question would be like, what percentage of world trade, like business to business transactions, do you think like move on to crypto rails, i.e. stable coins, over the next 5-10 years? If right now they're like less than 0.1%, what does that look like over the next 5-10 years? Like over, under 5, 10, 20, 30%?
So I did the math on this based on the Citibank and Standard Chartered projections for issuance. So if you look at the issuance and the volume, and I tend to use adjusted TPV, so I'm closer to 14 to 16 trillion than the 27 trillion, because the adjusted volume does account for bots and trading volume that you see in stablecoins. So if you take that conservative estimate of TPV today, then we don't know necessarily how much that's going to grow, but we do have good estimates of the growth of issuance. And the growth of issuance over the next 3 to 5 years is somewhere between 7 and 10x. So I calculated that Swift does about 5.3. So Swift says they do 5.3 trillion a day in volume, which would be roughly 1.8 quadrillion per year in Swift volume. If you take the TPV of around 14 trillion today and extrapolate that 7 to 10x, you get very closely to sort of 7 to 10% of Swift's global volume within 3 to 5 years, and that's not unrealistic at these growth rates. So that is. Imagine if there was a 7 to 10% of Swift payment network being built in the next 3 to 5 years. That's very serious and worth paying attention to. The banker DNA in me is a little bit like, there's gonna be AML risk here. There's gonna be new risks we're not expecting, but there's always that at the frontier. So I think we have to be thoughtful about those things. Whenever somebody says it's going to grow massively, that's going to be an opportunity for the bad guy as much as the good guy. But that shouldn't stop us from paying attention and taking it very seriously.
It's fascinating that, like, one, we're talking about an addressable market that's in the quadrillions, and it makes my brain hurt of like how many quadrillions is this, like that's how big this overall space of global money movement actually is. But I don't think it's this like zero sum Swift volume moving over to stablecoin volume. I think in many ways, like, stablecoin volume can grow Swift volume as well. Stablecoin volume can grow economic activity, which grows both stablecoins and Swift. And I think even if you just take the example of the Stripe product of what they announced for businesses, merchants in 100 countries, they can hold a balance in a stablecoin, which might be the only access that they have to a dollar-based business cash account. But then if they want to pay a supplier, they can initiate a wire transfer. They can initiate Swift transfer. They can initiate SEPA. So they can still use existing fiat rails. And I think for an extended period of time, most of the suppliers and businesses that they pay, if you are a merchant or a business in Vietnam and you're paying someone that's in the United States, whoever you're paying in the United States probably isn't going to accept stablecoins today, and they don't need to, because you could just fund a wire transfer that is basically a domestic wire, that comes out of Bridge's underlying bank, from a U.S. bank, to whoever the U.S. bank is that you're paying. And so what would have been likely a Swift transaction going through a local bank in one of those markets that then might have to go through multiple correspondents that would then have FX on it, now actually turns into a domestic wire from a bank in the U.S. To the recipient bank in the U.S. So I don't think it is necessarily all about switching volume when the money is moving over from traditional fiat rails into stablecoins. I think there's a big component of stablecoins acting as these dollar accounts when money's at rest, and then when money actually moves, being able to off ramp that and initiate local domestic payments that still go over the same rails that they do today.
It's trade that wouldn't have otherwise happened. Yeah.
You guys are experts on this, but is it fair to say that a lot of where the volume might come from, or is like there's a lot of like trapped capital, like working capital that sits in these like Novo Nostro accounts when you're doing trade, like all of that may not flow into stablecoins, but just like gets released into more productive uses in the economy?
I think that there's a little bit of that. If you're an existing global corporate like Coca-Cola, like that's going to be something where you operate in 191 countries, and Nostra Vostras will be a very large expense to you. But if you're Tesla or SpaceX, you probably didn't have a lot of Nostra Vostras, so this came along and solved the problem for you before you even hit that scale. And typically, you see that the businesses born more natively to the time frame a new technology comes along are A, the early adopters, and B, the fastest growing. So actually, I think this is, for financial institutions, for Swift, for everybody else, this is all opportunity cost and not downside. To Cuy's point, this is not zero sum, but it is extremely positive sum on the growth side. The question from a strategy standpoint is how much of that positive sum growth, which looks like it's going to be faster than Stripe's, do you want to be exposed to, and how do you get exposure to it? I think it's a very different question. All right, I do want to cover the next story because we're running out of time. I don't know if you saw this one as well, Santi, but Coinbase had two stories this week. One is their acquisition of Derbet is official. $2.9 billion was agreed, with $700 million of that in cash and $11 million in shares. So I'll come to you for perspectives on that. But also, what caught my eye was the announcement of X402, a new protocol for stablecoin acceptance on the internet. So maybe the first thing first, Derbet, what role do you think this would play in Coinbase's business, and why do you think this is strategic for both involved?
Yeah, I mean, it's massive. I mean, Derbet's a moneymaker, right? I mean, perps and options are like a huge market in crypto, and Coinbase product offering is lacked in that regard. If you look at like Binance as an organization, like some of the major exchanges do have more functionality, and yeah, it's really. I think it extends Coinbase's product offering at a time where regulatory the path towards like regulatory clarity on some of these things has been challenging in the past. I think it's not surprising that they bought it in this particular moment in time where we're about to have just more clarity. And Coinbase has had different offerings in different jurisdictions, but I do think that Derbet is sort of like the signal, which is, I think a lot of, you can almost imagine internally, they're like, okay, they've probably been looking at Derbet for a number of years, that it was interesting to supplement their product offering. And they said, God, now's the right time to strike because they're really close with regulators, and I think they have good visibility in integrating that in most of their jurisdictions. So it's really powerful, and I think it just complements their product offering quite a bit and makes it marginally more competitive relative to some of the other exchanges that are offshore.
Yeah, the M&A pushback maybe 2-3 years ago would have been quite a bit more significant than this one. I don't know if you have thoughts on this, Cuy, or if you want to jump to the next piece, because the story about X402 as a payments node really captivated me.
Yeah, I think X402 is fascinating. I haven't had a chance to dive into it in as much detail as I'd like, but I think one of the things that it speaks to is just the amount of innovation happening in different directions and use cases around stablecoins. And then, also just this intersection between stablecoins and AI. And, I thought at Stripe Sessions, there was the slide of like, there are two themes of the conference, and it's AI and stablecoins. So they were like right next to each other, which, I think has been consistent. Our product drop, last week, we talked about what we're doing in agentic commerce and an update on stablecoins. And so I think those have been really the two big themes of 2025, but they are still very much happening, independently. We haven't seen many direct integrations and intersections between AI and stablecoins that are like gaining traction at scale. I think that there's a lot of interest in how they can come together. I think that there's opportunity, but everyone's trying to figure out, agents are early, stablecoins arguably are like further along in some ways than agents. And so I think, these new initiatives around what are the protocols that agents will use to transact, and then will stablecoins be part of it? It's a really fascinating question that I'm excited to see how it plays out.
Tokenization was one of the things that unlocked e-commerce originally with card on file, and then tokenization unlocks mobile commerce with sort of Apple Pay, and that's a different kind of token, of course, than we talk about in the crypto world. But then tokenization of agents is a logical extension of that, because I know this agent, I can recognize it through the card networks. But one of the things that has evolved is the potential for something different to the subscription economy when your fee structure is as low as it is in stablecoins, and potentially agents operating with micropayments. And X402 builds on something that existed in the internet for a long time, which was HTTP 402. And the idea is, with just a few lines of code, you get built-in authentication and automatic settlement through stablecoins. And they've got some interesting partners here, AWS, Anthropic, and Circle, as well as, this really caught my attention, I didn't realize the founder of Near, who was also co-author of a little paper called Attention is All You Need. Of course, the paper that gave birth to the transformer model and the transformer architecture that goes on to become ChatGPT and LLMs. Santi, what are you seeing in where agentic commerce is meeting stablecoins? Is that just like two buzzwords having a baby, or is it like something real?
I think it's very real. Like, you want to bring productivity into the workforce or in your business or as an organization. Empowering AI agents require this type of functionality. Right? You go talk to, like, there's interviews, Tim Berners-Lee and the inventors of the internet said they sort of punted this problem. Like, you can move money, like you could move information and packets, but they didn't want to do the settlement of value on the internet. And so, like, this just comes in and like adds the internet, like extends the functionality of the internet. It's like an extension pack that is so powerful, like to transmit value. I don't think it's buzzwords at all. I mean, I think naturally, like, AI agents require like digital money and require this type of functionality to be very productive and do certain things that, like, you want them to trade, or you want them to like request, it's like transmit value. You kind of need this infrastructure in place because they can't KYC, they can't kind of work when the current, again, workflows of the traditional financial system. So honestly, it's like kind of went under the radar, I think, because there's so much news happening, but this might be we probably look back on this and say, wow, that was like a defining moment of just crypto being a powerful extension pack for the internet.
Yeah,
Like,
I think there's the big question of what are agents going to buy, and if agents are transacting at a traditional merchant on your behalf as a shopping assistant, that's exactly what we are enabling through our agentic Visa Intelligent Commerce solutions, and like there are a bunch of things that you can do to make it you have all the controls in place for an agent to be able to leverage a Visa credential to spend. I think for some of the infrastructure spend, are agents transacting with other agents? Are they transacting with cloud platforms, or are they buying LLM tokens? Like for those, is this like the messaging was all about killing the API key, which I thought was interesting, where you're used to, if you're building something, you go and sign up, you get an API key, you then pay for some credits or some a subscription. If you don't actually know what developer service you need, if you ask your agent, hey, I want you to do a task, and then the agent has to figure out what service they need to complete the task, and maybe there are 10 services that they need, and they could just automatically purchase those pay as you go using a protocol, like then that gets kind of interesting. But I also still come back to, like, if the agent works for you and you have a card, why can't they just use your card? And I think from a micropayment perspective, it's really just a business model question of if there's enough demand, and we see real value in micropayments, which we haven't really seen demand for micropayments at scale. Then I think there are a lot of ways that we could support that as well. While at the same time, people talk about micropayments and stablecoins. Even though gas fees have gone down, you're still paying a cent, and so you can't really do a subset microtransaction. So I think there are a lot of questions around how do these use cases play out, and what are actually the problems that stablecoins solve, versus what enhancements can be made to existing networks to support them.
Yeah, and the answer usually is all of the above. I wrote a piece a little while ago, The Four Models of Agentic Commerce, where you see the evolution of just like somebody using Operator, and it's almost as if it's typing in your screen, and then it stops and asks you for card information. Then there's a company called Not APIs that does card on file, which is just like storing your card at Amazon, but the agent gets there and it uses the card you've got stored on file, but knows an agent's doing it. Then there's the virtual card model, which is what Stripe is live with, that says, oh, you've landed on a Stripe checkout, your agent's landed here, let's give this agent that we recognize a virtual card. Now there's Visa's tokenization model that says, actually, this is a known agent, it's checking out, we understand this at the network level, and we know that it belongs to this user, which adds a lot of potential fraud and chargeback protections. And then there's stablecoins. And honestly, we just don't know which of those it will be, but stablecoins is part of that conversation. With these things, though, like having something really neat and elegant at the top level for the merchant to be able to recognize, hey, an agent is coming to my website. An agent is browsing around a little bit and now has an intent to make a payment. I think that handshake is potentially hugely valuable. But my rambling aside, I know we're up against it on time. So I want to thank everybody for listening and watching. And I want to thank Cuy so much, as always. Where can people find out more about you, my co-host, my friend?
On X at Cuy Sheffield and visa.com/crypto.
And Santi, where can people find out more about you and Inversion Capital?
Yeah, on X, Santiago Roel, and inversioncap.com.
You'll find me at SY Taylor, fintechbrainfood.com, and of course sardine.ai if you're worried about any of the fraud and compliance issues that all of this implicates. Thank you very much. If you enjoyed this, please remember to subscribe, like, tell your friends, spread the good word, and leave us a review or a comment. It really helps others find the show. Thank you, and bye for now.